Hey there, fellow investors. Today, we're talking about the 2023 economy. And let me tell you, it's been a wild ride. We've got high inflation, the Federal Reserve raising rates, and the stock market has been taking a bit of a beating. But guess what? That hasn't stopped the world's best investors from buying into the market. Warren Buffett, for example. You won't believe what he did in 2022. While everyone else was selling, this guy went all in and dumped a huge chunk of money into the market. Yep, you heard that right. Investors like him have been busy making moves, and we're here to spill the tea on what they've been up to. So grab your popcorn and let's get started. In the long run, the strategy of making big investments when the economy is bad has worked out very well. But there are a few rules to remember if you want to be successful. The first is to look for businesses that have a long-term edge over their competitors. This is especially important during times of high inflation and bad economic times. Imagine living in a small American town where there isn't even a Thai restaurant. Then someone notices that and thinks, I think my restaurant will do really well here, and opens a Thai restaurant. They do a great job, are always full, and can charge more than New York and other big towns. As a result, more people and business owners are opening Thai restaurants. Eventually, the economy of Thai restaurants in that small city may be the same as in other parts of the USA. Because of the nature of capitalism, if someone creates a bigger, higher return product, it will attract a lot of rivals to enter the market. They will work to undermine any advantages it may have. Being first or doing something else may work for a while, but it doesn't last forever. And this is a crucial aspect. You know, Snapchat introduced stories first, but it failed. Video games were invented by Atari, but they fell short. The original mobile phone manufacturer, Motorola, fell short. Being the first to do anything is great, but what you really need to look for is an inherent quality that irrevocably distinguishes it from its rivals that no matter how hard they try, no other company can ever match. This is what we refer to as the moat. And we see this a lot these days. Coke is less popular than Pepsi, but it has a moat that can never be made again. Coke says that the secret is locked up in a bank vault in Atlanta, but it's pretty easy to make a copy of Coke, and a number of companies have already done so. In the 1980s, Pepsi started the Pepsi Challenge. Basically, people were given two colas without any branding on them and asked, "Tell us which one is better." Most people liked Pepsi because it was a little bit sweeter. However, if they offered the two beverages to the majority of people with the brands Coke and Pepsi, they would choose Coke. Therefore, Coke's moat truly makes no sense when viewed objectively. It's an example of how capitalism sometimes leads to mistakes. The brand moats are frequently the strongest moats. Coke is without a doubt the most popular beverage in the world. Although it seems counterintuitive, firms with highly coveted stickers actually have the strongest moats and are among of the finest to acquire as an investment in difficult economic times. Having a moat essentially means that customers will continue to use your goods or services and won't look elsewhere. And it means that when people are strapped for cash, they won't buy the less expensive goods and will instead buy yours. Ferrari is yet another business with a brand moat. Although there are less expensive cars and hypercars available, demand for Ferrari just never declines. Louis Vuitton is another example. They are made from the same materials as others, but brands are what people purchase. They desire the style, the emblem, and all that it stands for. Having said that, no moat lasts forever. Because of the nature of capitalism, a moat is likely to be eventually filled in. Therefore, very few newly created enterprises survive through their first year. Few of them will live through their 5th year, and even fewer will survive past their 10th, 20th, or 30th year. As investors, it is our responsibility to imagine how businesses that appear dominating now might appear in 5, 10, or 20 years. And it's really challenging because the brand always has to defend itself against raiding attackers who want to steal its moat and profit. So even if Apple is an absurdly powerful firm with a big moat, investors always have to be aware of the moat's strength. And how do you identify them? Examine the sales, profits per share, free cash flow, and equity performance over the long term. And simply check to see if they continuously grow at a rate higher than 10% annually. The Apple chart appears to be in fine shape, although share purchases might cause equity to fluctuate. Companies that have been able to develop continuously for a very long time appear to have a moat. On the other hand, if sales or earnings were going down, there was a lot of negative press. They were closing stores, etc. These could all be signs that the moat was actually being broken. But the first thing you need to know about value buying in a tough economy is how to find companies with a moat. Well, as value buyers, we can use patience as one of our tools. We don't really have an edge when it comes to information. If I look at a company, there isn't much I can find out that many people haven't already found out or can't find out. The data edge is when two people get the same information, but one of them is able to look at it and come to different conclusions than the other. So, having an intellectual edge can be a real benefit, but even that can be hard because many smart people are studying many different companies. The one thing that Amazon has going for it is probably the longer time frame. Jeff Bezos says that many of his competitors only think about the next 1, 2, or 3 years. Amazon, on the other hand, has always thought 5, 7, or 10 years ahead. He also said that investors had an edge and were more willing to take risks when they had a longer time span than 3 years. This is true both for companies and for us as a customer. As value owners, having a long-term view is the best thing we can do. The active funds on Wall Street trick people to think very short-term, like from quarter to quarter. But buying for long-term gain is a waiting game. We buy great businesses when the time is right, and then all we have to do is wait. So, we keep our money in companies with known moats and try to keep them for as long as possible. And you should never forget once you found the big winner. There aren't many great businesses that are listed on stock markets. Hold on for dear life if you are lucky enough to own a piece of one of these. Give them a couple of decades to do what you thought they would do, like Amazon, Google, and Tencent. Give it 20 years to grow. Value buyers use this not-so-secret method to make money, even when the economy isn't doing well. With this, we wrap up this episode of Informed Investing. Do you think you can now identify a business to invest during recession? You know how to tell its key trait. Drop a line in the comments and let us know. Thanks for watching. Please subscribe to the channel and hit the like button if you enjoyed the video, so that you get immediate notifications when we upload a new one.